Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that,
Ice raw sugar in New York. The main pattern here since September 2024, so for well over a year and close to a year and a half, has been, though I'm now starting to look at another pattern, has been, despite being breached and repaired, the dark blue September to December 2024 bear channel. It's currently 954 to 1449. That developed into a descending expanding wedge pattern. We're at this time outside and on top of the dark blue upper trend line and have been since late December last year, but the market will still not let go of this pattern, though I suspect we are coming to an end. The mauve medium moving average, currently at 1522 in recent times, has acted as a dynamic cap on prices, whilst the green short medium moving average, currently at 1476, is acting more as a support nowadays after earlier being a capping resistance. There are two other patterns that have greatly influenced this market. The first, and the one I think may be trying to take over as the main pattern here, is the bright green late September 2024 to late February 2025 bearish shift pitchfork. I drew the original bearish Andrews pitchfork for this move some 43 weeks ago, as it seemed back then to be a better contender in showing the bearish angle of attack. But that did not last, and I finessed it to the shallower bearish shift pitchfork for the same move. Today we are just above the bright green middle time, which is currently at 1455. Now the second pattern is another larger bearish pattern, which I have also previously spoken about, and a good contender even now in showing the bearish angle of attack. It's the longer term bright red November 2023 to September 2024, similar but slightly shallower bearish shift pitchfork. On this one we are a little above the bright red middle time, which is currently at 1383. We also have, or seem to have had for months now, the March 2021 low in there at 1466. Further below we have, as I said 12 weeks ago, and I quote, "We next have support on the downside on congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379. All that is needed for these to be tested is stabilization under the bright red middle time." End of quote. Well, we had that stabilization between late October and early November and nothing much happened. So the market started to move back up over the bright red middle time, but it was constrained in its height by, initially, the bright green middle time and then the mauve medium moving average. Below this support, between 1379 to 1409, well, we really don't have that much support until around the 1248 level, and I'm not too confident about this supposed support down there as well. We also have a gap between 1336 down to 1320, dating from September 2020. So a lot has depended on that congestion support between 1379 to 1409. On top of all that, October was a monthly key reversal down, a bearish factor. Though, as I said 12 weeks ago, and I quote, "I can't help thinking that maybe such a pattern could be seen as a swan song. However, until otherwise the pressure is still on the downside." End of quote. Well, even there the pressure is still on the downside, though we seem to have undergone a small, mild halt in the decline right now, and this has prompted me to start thinking about whether the mid-November 25 today action might be a possible rectangle pattern between about 1440 up to 1535. More on this as it develops over the next few weeks. Ice Europe white sugar in London. After all this time, there still continues to be three features of this market to keep bearing in mind on this daily chart. The first of the three features is the obvious broken, repaired, broken again, repaired, and lately broken purple late September 2024 to mid-February 2025 descending expanding wedge pattern. It's currently 413 even to way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary made back in January 2025 and had earlier been seriously tested on the top side. Enough that I would not necessarily classify as a descending wedge pattern after February 2025, though I continue to still keep an eye on the extension to the purple upper trend line. As it is, bar some congestion at 425.5, the nearest support resistance of this market. Now the one caveat to this trend line is how it was broken on the upside 8 weeks ago. But even now, the market has still not untangled itself from its vicinity. Next, I also asked you 38 weeks ago to, and I quote, keep an eye on the bright pink late September 24 to mid-March 2025 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. End of quote. Well, since then, the market initially started utilizing the bright pink middle sign of this bearish shift pitchfork, which is currently at 445 even, as an attractor, riding prices lower in a shallow glide until early October 2025, when it started a further steeper journey lower, such that in early November 2025, the market had been closer to the pink lower tine, which is currently 386.60. However, we have seen a pull upwards since mid-November last year and is now using the congestion at 425.5 as a seeming attractor. So we're in between two bearish pink tines. The third feature, which developed since the beginning of September and late 12 weeks ago and saw prices break above it, is the bright red early September to late November bear channel. Like the November last year bear channel. This bear channel had been excellent at showing the summer into autumn 2025 bearishness of the market, including 12 weeks ago the lowest low since December 2020. However, that same week prices broke above and out of the bright red bear channel, and late 9 weeks ago stabilized over it. As a result, 8 weeks ago I laid out possible targets for this break higher, of a primary target X up in the 447.40 area and a secondary harder to achieve target X1 up in the 454 even area. I was not too sure about these two targets, as in the past the green short medium moving average, which is currently at 423.5, had been very effective in batting prices back down, but for now they still stand. I'd also note the mauve medium moving average, currently at 439.30, which had tracked along parallel to the bright pink middle tine since last year and has started dipping below it. Now, this has happened before, but it is worth pointing out nevertheless that as I think it will become more relevant in the coming weeks, as the market and the medium moving average continue to approach each other. And one final feature, and this is true in New York Sugar as well as London, and that is we might possibly be forming a rectangle pattern between roughly 415 even here to just over 435 even. More on this as it develops over the next few weeks. Sugar white premium spread. This one has been a very disappointing one. Not because of the market doing the opposite what I thought the patterns might indicate, but because the market has instead done nothing, or at least nothing much. 18 weeks ago I said here, and I quote, "Things seem to be trying to resolve themselves into a pattern," end of quote. And over the intervening weeks they seem to be doing just that, though not always the way I imagined they would, or even to a clear resolution. You see, I thought we might be moving towards, as I cautioned for a number of months, and again I quote, "I have a fear, and it's a real fear, that the whole February 2025 today action may be trying to form a possible diamond pattern," end of quote. Now I continued, and I once again quote, "This would be a large pattern in time, probably from February through to November this year, and in height roughly between just under 100 up to 150. It is too early to say if this is happening, but I would urge you to keep an eye on such a possibility." End of quote. That possibility looked real until 18 weeks ago, when the market dropped down and below what I thought might be the lower bullish trend line, highlighted in dark blue. The market not only dropped below this trend line, and let's be honest, it is an unjustified trend line, but went on further to drop and close below the gold long moving average, which is currently at 109 even, stabilizing further down and dropping and closing below a new support line, the bright red neckline, which is currently at 97 3/4, of a new, simpler pattern, which the market opted to utilize instead of the more complex diamond pattern. It became a February to early October head and shoulders top. The issue I had and still have with this pattern is that we are now past the early stages, and we really haven't confirmed a move either higher, above the gold long moving average, or lower, sufficiently below the bright red neckline extension. I chose 14 weeks ago to lay out some potentials below for such a head and shoulders top pattern, just in case. Thus the primary target X is down in the 70 even zone, with a secondary harder to reach target X1 down at 43 3/4. You will easily note that primary target X is at the lower end of the congestion seen between September 2024 to January 2025, between approximately 70 even to 85 even. Since then, nothing, or at least nothing much has occurred. We even had a weekly key reversal up last week, but at the same time it was also an indecisive doji cross. This is not the only contradictory pattern out there in recent times. There are contradictory patterns out there, and quite a few of them as well. It all still comes down to what I said 14 weeks ago, and I quote, "Only concerted, consistent and long-term moves over the new bright red neckline, and ideally over the slowly rising long moving average, could possibly assuage the bearish potential, at least as far down as the 70 even to 85 even congestion." End of quote. We had been half there and then half not there, and the moves over the last 10 weeks just exemplifies these half in and half out contradictory courses of action. It is indecision, but on a much, much larger scale, more than just a weekly chart can really show.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.